Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. The last few months have been an extraordinary time to be diversified to the fullest extent possible. Fidelity All-in-one ETFs were designed to proceed with precision and protection in exactly such unknown waters. By tapping into all investment factors from low vol to quality and momentum, as well as giving investors exposure appropriate for their level of either conservatism or more of a tilt to risk, Fidelity ETFs have plowed through choppy waters since inception. Here to take us through the expanding playing field for the Fidelity ETF lineup is Director of ETF and Alternatives Strategy, Étienne Joncas Bouchard. Welcome, Étienne. Great to see you. How are you?
I'm doing very well. Great to be here.
Yeah, you're there in Montreal. We're delighted to have this time with you. You've just finished taking questions in French in a French webcast. Actually, what was the top question you got there? Let's just connect the two.
Great questions came in as usual. Our audience always does have good ones for us. The first one, the one that came in that was the most popular was definitely more comments around attribution for our all-in-one ETF. So basically, what's been driving the ship this year? Obviously, it's been, I think you mentioned in your introduction very well that it's been, I guess, an interesting time, let's put it that way, where there's been already many shifts in momentum, as much on the fixed income side as on the equity side, where various investment factors have performed very well at certain periods, then going out of favor in terms of weekly to monthly bases. So we dug into that a little bit.
And that brings us actually to the flows story, doesn't it? So I'm excited that you'll share with us actually the May flows data. We have a couple of slides for this as well, but what would be sort of a broad statement? Because I think when we spoke to you last, April obviously captured some interesting moments after the Liberation Day story, but really it was May that we were kind of looking to get some of those. How would you sum up flows in May?
We're back.
Yeah, that's good.
Yeah, if we could put up slide one, that'd be great. We can show our audience kind of some of the key points with regards to ETF flows in the Canadian ETF industry. I guess the we're back as just highlighting the $9.2 billion that came in May. There was a slowdown in April, but nonetheless, it was still the Canadian ETF industry was still in positive inflows in April. It's just not to the scale, if you will, of the other months that we had seen so far in the year, and then definitely in May. Close to 10 billion coming in, which is, kind of really strong if you seasonally adjust it, if you will. You generally see a slowdown in the summer months a little bit. So that was really good to see. Just from a Fidelity standpoint, it was actually a record month for us in terms of inflows. So obviously, thank you to everybody who's listening in today who's supporting that. But some of the other key points I'd like to mention here. First of all, $48 billion in net new assets so far this year as of the end of May. We're on pace for a record year, last year being that record at $76 billion, which I mentioned many times already, but I'd just like to highlight it again that we're basically more than, not even halfway through the year, and we're definitely on pace for that. In terms of kind of more, granular stories, if you will, the international trade continues to be fairly hot, I will say. Okay. $2.7 billion in May, bringing the total for the year at around close to $14 billion, which is almost double that of U.S. equity ETFs. Albeit we did see a rebound in demand for U.S. equities in May. That was basically zero in April due to obviously the heightened volatility that we saw in U.S. markets. So all around, it's just a pretty positive month for the Canadian ETF industry, and definitely for us at Fidelity, like I said, which is a record month for us in terms of inflows. So
really interesting just to compare the 2 months though, because April. I'm just wondering how we're all looking at numbers to see how that was demonstrated for investors. And so how was it demonstrated in the ETF flow versus April versus May? May does look very good for all those reasons that you just mentioned, but I'm just curious, what did you notice in terms of a drop-off in interest either in April versus May, basically?
Yeah, I think it was a complete shift in the types of strategies that were being, put into focus. Or more in demand, I should say, a better way of phrasing it. April, you saw naturally as volatility manifests itself, you see risk-off type strategies becoming popular again. So we saw, I think we had mentioned it maybe in our April call, or maybe these get kind of blurred up, but there was a really big spike in demand for low volatility equity ETFs like around Liberation Day, close to $4 billion in the span of 2 weeks, and then all of a sudden, we're not talking about it anymore. We
Right.
haven't seen much going into that category. On the fixed income side, it's kind of evident also by the type of duration or the type of strategies being bought from a duration perspective. So you saw a return to kind of the cash alternative, very short-term stuff in April. And then all of a sudden you're looking at May, and now you're seeing a lot of demand for kind of aggregate Canadian bond type products again, which had led the way up until April. And then once again, the risk off sentiment comes in, people go shorter duration, you take some risk off the table, and then we're right back. Right, so I guess I'll mention it many times, but we're back in May with kind of a risk-on approach for sure.
You should trademark that. I think that's good. So to go to the idea of how you design the all-in-one ETFs, for instance, like let's just add into. I think a lot of people are familiar with them, but it's good to sort of repeat some of the pieces. When you talk about low vol actually being in the rearview mirror now, it was very important for a number of weeks there because people were worried.
Yes.
But your exposure to the different factors, be they low vol, quality, momentum, and so on, actually doesn't change, right? You just carry on with having exposure to all of them. Can you just kind of go through that for us again? There might be a slide that's useful for that.
Yeah, we can bring up slide 2, which is just kind of the entire lineup of our all-in-one ETFs, which are actually, even this is not the right slide, maybe slide 3, excuse me. Just make sure we have yep, there we go. Okay, so if we're talking about our all-in-one ETFs, even to take a quick step back for those that maybe are not so much familiar with the lineup, this is really kind of the culmination of many years' work in building what we feel the best diversified portfolio with the use of our ETF lineup. And to your point, Pamela, as you mentioned, we have exposure to kind of the 4 main factors in low volatility, high quality, momentum, and value. Those are what we call strategic allocations, right? We're not looking to overweight, underweight in certain factors as we go through the investment cycle, albeit they are very cyclical. The objective is to, by combining them, capturing the long-term strategic alpha that we generally see with factor-type investment strategies. So we want to capture that. We don't want to make a call that's going to put us into a camp where, whether that call is right or wrong. We just also, from a risk management perspective, generally benefit from having an equal weight approach to our investment factors.
That's fantastic. And you just got a quick tech update there, which is great. It's
live
TV. You got to have these things happen. Earpieces fall out and that kind of thing. So that's brilliant on the factor side of things. I don't know. I wonder if we might bring that slide back up again and then talk through the different types, because it goes to what you're talking about with fixed income. And I wonder if you can just kind of point out the more conservative leaning approaches and options that you have for investors, again, if they're going through choppy waters and are very, very concerned. There's a conservative fund for that.
Absolutely. If we want to bring that slide back up, we can kind of run through the lineup very briefly. And I guess the 2 new ones on, I guess, the left side of your screen, which are FFIX and FCIP. Those actually are fairly new. We launched them last week, so June 3rd was our launch date. So we're very excited to bring those to market. The idea was to round out the lineup with 2 low-risk options, whereas the others were medium or medium to high for FEQT. So we're very excited to offer these options now. I think it comes from the demand that we saw from advisors that said, for my more risk-averse investors, it'd be nice to have an option that has a bit more fixed income in it, which is, by all means, something that we have on our managed portfolio platform, if you will, or product lineup. Same thing for the private investment pools. So it only made sense that on our ETF portfolios, we would do the same. So yeah, very excited to launch those. The fixed income allocations, if you will, are bigger, but the split among kind of the weights for each individual fixed income strategy is the same across all the portfolios, right? So 70% of our bonds will be Canadian investment grade bonds in our systematic Canadian bond ETF. And then we round that out with about 12.5% into absolute income global core plus bond. And then, a small allocation into the core US bond product, which is more of a kind of aggregate bond type solution that's fairly investment grade, or entirely investment grade, I should say. So those strategies, I think, just round out the lineup, more options, more flexibility. Why not?
Why not? And let's go to sort of the other big story, which has been a story for actually several months now. Again, how it's come into the ETFs. This is the international trade. You mentioned it off the top as being certainly one of the interesting ways that investors chose to invest through the month of May for a lot of reasons that we all know. Take us to the international fund itself. Remind us, again, I think we've been here before, but it launched well in time to capture this big swing to international interest. When did it launch? And essentially, what are you investing in if you're taking a look at this ETF fund?
Sure. So actually, the product that you're referring to would be our All International Equity ETF. The ticker is FCIN. And I can say now, happily, last week we made it available as a mutual fund as well. So we have it now available in Series B and Series F. So very excited about that. Continues on the idea of offering options and flexibility to advisors. But I truly love that strategy. It is a more core approach to investing internationally relative to, say, our other products that we have that invest in international equities, which are more factor specific. So obviously we launched we started with our dividend ETFs, and we had value, quality, low vol, momentum. Like those are very niche type strategies where you use them as great portfolio construction tools, but then also have the cyclicality effect of when you go through different phases of the business cycle, they will go in and out of favor. There are 100 stocks, right? So kind of more like a complement, if you will, or a satellite position to something maybe a bit more core. So what we did with the All International that we launched last year, similar approach to the all-in-ones, is just say, let's just bundle the four main factors together. Let's rebalance them systematically. Let's give an experience that's going to be very correlated to the broad benchmark index, which is for us the MSCI IFI index that we look at, which is about a correlation of point.
Yeah, it's developed
Yes,
markets.
Exactly. International developed markets, exactly.
Is there another, and I don't know if this is a reason, I'm asking you, is another reason for that is that a lot of the largest stocks or the biggest companies in IFA are actually multinational. So in some ways you're not getting, I don't know how much exposure they necessarily have to the US, for instance, but if you're trying to create a product that is giving you everything else, is there something to that?
They're definitely global companies for the most part. I mean, obviously, you can look on the different scale of cap, but probably if you go to like the mid caps, small caps, obviously similar to the US, probably have more of a domestic bias. But if you look at the names that you'll find in, at the top of the MSCI IFI index, these are a lot of names that we know, and, just thinking of SAP being the largest holding, like that's one of the biggest enterprise resource planning software firms in the world. You have Nestle's of the world, you have ASML, huge, semiconductor company. These businesses are very wide-reaching. Obviously, a lot of them are very high-quality businesses, but we don't own a ton of them as Canadian investors because, one, if you're buying them as a standalone stock, it's obviously you have to go through an ADR usually, or it's a bit more complex to buy to a certain point, and also there's just a domestic bias that we tend to have as investors, and this is as true for Canadians, as Americans, as Europeans. Everybody's got a domestic bias, which is natural. But with the way the international markets have performed, and you look at the quality of a lot of these businesses, it might not be a bad thing to consider diversification from a geographic perspective at this time.
So just going back to the point you made about this fund now being offered as a mutual fund as well.
Yeah.
Why do you do that as kind of a general comment?
Yeah, it's a great question. Our main objective is truly to give as much flexibility to the advisors that we work with. So obviously, some advisors, can't necessarily buy an ETF direct, right? So through an exchange. So offering it in a Series B, Series F just gives them access to the strategies that we have without necessarily using the ETF vehicle. All right. So and this is kind of like a battle that we consistently go through is that, we try to talk about our ETFs as strategies, not as the investment vehicle, right? So when we talk about our all-in-one ETFs or we talk about our all-international equity ETF, like we're pitching the story, we're talking about how we're constructing the portfolios. We're not talking about it being an ETF or a fund. We're just talking about the investment strategy. And so having more options is better to us. There are advantages and disadvantages to buying it in a mutual fund vehicle versus an ETF vehicle. As an example, through a fund vehicle, it's easier to set up systematic purchases, systematic withdrawals. So for people who are, gradually accumulating or gradually, taking money out of their account, it might be easier to set up for an advisor using a fund series. So those are some of the main points, but it's really all up to flexibility and options.
How often is the asset mix or components of the all-in-ones reviewed, maybe rebalanced? Just speak to the rebalancing and how that works.
Yeah, so I can definitely speak to the rebalancing. So our objective is to go back to the neutral mix that we showed previously once a year. So we have an annual rebalancing set in place, which is in at around the third Friday of January. Obviously, depending on market conditions, if there's an opportunity to do it on the Thursday or doing the next Monday, based on liquidity, we can. But that's around the target that we look at. Inside, obviously, the underlying ETFs have their own rebalancing schedules, but if we look at just the portfolios, other than that yearly rebalancing, we do have kind of these risk parentheses, if you will, like, or deviation limits, I should say, maybe is a better way of phrasing it, of 5% per asset class. So if ever, in our all-in-one balanced, the 60-40 mix gets the 65-35, we would then trigger a rebalancing the next day. For crypto allocation, the max that we can go to is double the base allocation. So if it's 2% in our balanced and it gets to 4%, then we'll trim it back down to 2.
Okay.
Right? So that's the main points, I'd say, for the rebalancing. Every day that we also get inflows, or if we get outflows, if we get inflows, we're buying the parts that are, underweight relative to the neutral mix. And then if we're getting outflows, we're selling the parts that are overweight relative to the neutral mix to try to consistently bring that back to neutral.
Yeah. No, fascinating how, and what triggers that and how you go about that. I think it's really interesting for everyone. To go back to the regionals, so the international is one. You also have All Canada, you have US. Yeah. There's a slide for this. But within that discussion of the All American one, actually, you mentioned we're back, and part of that actually is the US trade is back, and part of that is the tech and the Mag 7. So I wonder if we can put up the regionals chart again. I think that's 3.
Sure. Yeah, that's slide 2, I believe.
2? Okay. And just speak to sort of, what you see in terms of not wanting to miss that, right? Because everyone was sort of worried, and then it was back all in a month.
Well, I think it just goes to show once again that, sentiment and behavior is very strong in our world, and that's normal. We react to bouts of volatility. But I'd say for the most part, I think many investors were thinking, let's stand pat because, the US remains the largest economy in the world, and it remains one of the most competitive markets and has some of the most competitive, companies. So if you look from a stock perspective, it definitely makes sense to own US equities. And if we even just look at our all-in-one ETF, 50% of our equity allocation is in the US. And that US equity allocation is basically the All-American Equity ETF, which we see on the screen here, which is an equal weight exposure to the 4 kind of main factors. So same kind of concept as for the All-in-One, same concept for the All-American as for the All-International as All-Canadian. It's just, those individual mandates underlying just, have, US, Canadian, or international investment universes, if you will. Yeah. What I really like about the All-American one, that comment you made with regards to the Mag 7 and kind of the top 10 participating in the rally that we've seen, that was somewhat the worry for a lot of investors to start the year, and even at the end of 2023, end of 2024, obviously, was that that part of the index was become very heavy and was too big of a share of the contribution to earnings of the entire U.S. Index, if you will. So from our perspective, because we're looking at fundamental characteristics to select the stocks, whether that's valuation or quality metrics is synonymous with profitability, or momentum, positive change, low volatility, we'll naturally generally own less of those big names because it's hard for us to select one of those stocks based on all of these fundamental characteristics. it might be captured in momentum and quality because they're fairly profitable firms, but they're generally a bit more volatile, especially if you look at an Nvidia, for example, and they're generally not cheap, right? So it's, we're generally underweight in value, for example. So when you do the sum of all parts, we have about an 18% allocation to the top 10 in the S&P 500 versus close to 30 in the S&P 500. So this is kind of a way to diversify yourself in the U.S. because 3 sectors now make up 50% of the index, which thankfully they've rallied because they are the largest part of the index. But if you're looking for a way to diversify that allocation a little bit, I think the All-American can accomplish that. So
one of the things I just want to pick up on that I think you were saying there is the idea of being so diversified, and you can do that within an All-American investment case or international or any of the all-in-ones with the different strategies for balance and so on. But there's an ability there that it strikes me, it allows investors, because it is so diversified in its strategy and the way it's designed, to hold on through these markets and to ultimately not hit the sell button, right? There's an ability that something else will catch you, even if another piece of that area of the investment universe is falling.
100%, and it's almost going back to the concept of systematic investing or factor investing or quant investing is because of the nature of the structure, the methodology does not allow for daily changes. It doesn't. There's fixed rebalancing periods, and depending on when that falls, that might mean that we have a lot of rotation in the portfolio. It might mean we don't have rotation in the portfolio. What it is not doing is reacting to headlines. It's not reacting to news. It's not reacting to like behavioral shifts that we've seen in the market. It's literally just relying on data. So unless there's a fundamental change to a certain sector, a certain company, a certain geography to a certain extent, it's not going to react to it unless it starts to see the data change. So valuations move up, profitability, or basically margins coming down. Like, it's going to react. Yes, albeit you could argue that it's going to be reactionary and not, proactive, but that's a good and bad thing in certain, but it's just understanding that that's kind of the way that factor strategies work. And obviously they've shown to work over time. It's just a different approach than active management, for example.
Étienne, did you start as a quant?
Not really. Yeah. I'm more kind of a trained. I wouldn't even consider myself a quant. Like the true experts are our quantitative index team in Boston. These are the folks that have created a lot of our index or like strategies. I say index like strategies, and I don't want people to associate that with passive investing, because passive investing just means market cap based indexes. Our indexes that we build are based on a bunch of other criteria that are proprietary that we've built at Fidelity. Those are the real quants. Those are the real smart folks. I'm kind of more the, the face now of a lot of these portfolios. But the construction and the real hard work was done
come from a
by our
rocket
quantitative index
team.
team.
Yeah,
exactly.
You've got a rocket scientist, Bobby Barnes, heading that up. That's fantastic. Now I want to kind of ask you the other side of being able to hold on, not reacting to headlines, as you mentioned.
Yep.
But at the same time, for instance, wanting to capture some of the changes that are going on in the market, in this massive macro-led market, or largely macro-led market. For instance, there was a time when, if you're looking international, there's certain things that popped up at certain times. I guess, how do you capture some of the things that are large, momentous, and make sure that you're not so smoothed out that you're not getting exposure to the stuff that's upside?
For sure. And and hence kind of why, like, also we rebalance at least twice a year. Like, we're trying to, as things change, to react. We don't want to not capture any major shifts. And obviously the one that's going to be the most reactionary and the one that captures the most momentum is the momentum factor, which rebalances quarterly, which is looking at not only price changes, but did a certain company miss or hit on their earnings estimates. Like, these are things that we also consider when selecting those stocks based on momentum. That's really the one that's going to capture those changes, and hence why it's somewhat like a chameleon to a certain extent, where one quarter to another it can change fairly rapidly, right? So to look at it and say, oh, I like this ETF because it's got 35% allocation to tech in the U.S. Well, that could go down to 20 the quarter after if all of a sudden it goes out of favor. So the momentum factor is really unique, whereas you kind of just gotta trust the process, if you will, right. And it generally works over time, but it's going to be fairly different from a quarter to a quarter, and especially year over year. So if somebody's looking for that, that's one way to do it for sure. And obviously another way to do it is using an active manager that's got his very good pulse set on the markets, which we have a bunch of great managers here at Fidelity.
I got a number of those. Just a final thought. We've come to the end of our time here that you'd like to leave investors with, either specifically on the all-in-ones or something more broad. But what's sort of the thing that you're going to make sure you are watching very, very closely over the next, medium term?
I'm interested to see where rates go. I think that's going to be a big story. You've heard a lot of people on whether it's CNBC or BNN or whatever it may be, talk about the kind of bond market being potentially in trouble. I'm really interested to see where central banks are going to be going with rates. Obviously, Canada hold, but it feels almost like there maybe should have been a cut. That's definitely going to drive bond markets, and obviously has a large impact on so many Canadian investors just by looking at demographics. You can see that we hold more fixed income now than we ever have. So I think that's going to be a major component to look out for. But in terms of final message, the one thing I'd like to say is thank you to everyone. We've had a record year so far here at Fidelity, and we would definitely not be able to do that without the help of all the advisors that we work with. And that culminated in our, I mentioned it earlier, but the best month we've ever had in May. So thank you for your support. We're continuing to work hard to make sure our portfolios are the best they can be. And yeah, look forward to the rest of the year and getting to see more advisors across the country.
Étienne, safe travels to you as you do travel across the country. Thank you for joining us today, and we'll see you next time.
A pleasure. Thank you.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.